Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was another down day for the markets, with the Dow shedding nearly 700 points. It's after tariffs against China, Canada, and Mexico went into effect, and each country vowed retaliatory measures. We're going to dive into the rest of the day's market trends. Then shipment data out of China, just the latest piece of bad news for Tesla. We're going to explore the EV makers' declining fortunes and what it could do to turn things around. Plus, 2025 hasn't seen the wave of IPOs that many might have expected, but we do finally have our first big one of the year. We're going to take a look at the IPO landscape straight ahead. Well, U.S. stocks closing lower with the S&P 500 eliminating its post-election gains now. Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
Thank you. We had the makings of a technical bounce today, and I guess we got that. Had a very negative close, though. So let me go over the price action here, and specifically I want to reference the S&P 500. I did a study of the last 16 times going back to the early 60s when the S&P 500 bounced off of its 200-day moving average after it was already at a 52-week high or a record high within the past 15 days. So basically, you're at a record high S&P 500, falls to the 200-day, bounces a little bit. What happens over the coming week, month, quarter, 6 months, year? It's actually pretty negative until you get up to about the quarter time frame. And I was actually surprised how negative it was. This green line here is percent positive. That's on the right here. It's only percent positive about 30% of the time, which is very low for any kind of statistical study in stocks because stocks tend to go up. And if you look at the returns here, they're just slightly negative. We're looking at median returns. And also a caveat here, it's a small sample size. 16 events is not huge, but you can see finally the gains pick up here. We actually have 80% positivity over the following quarter. That leads me to believe we still got some juice in the tank in this bull market. That percentage positive goes down to about 70%, but you can see the gains rise over the 6 months to a year after that. Some outliers here, Josh, real quick. I just want to go over 2018 was an outlier year. We had Volmageddon, for anybody who remembers that, in February of that year. It was a one-off event. The bull market was intact, recovered, things were fine, but we also have 2007 and 2015 as warnings. 2007 was global financial crisis. What happened then? We got a downturn. Then we got that after 3 months there. We got that nice rise there, and then it was really off to the races to the downside. So the bottom line is, I think we got some orange warning flags. We had yellow warning flags yesterday, orange today.
What else are we looking at?
All right, let us get to that. We got bearish sentiment. So I like to look at sentiment because sometimes when you have really negative sentiment, it's actually good for the market. So I was looking at the CNN Fear and Greed Index today. That was in extreme fear territory. We just got the AAII Bulls Bears report out. That was the 8th lowest readings going back to the beginning in 1987. But I have a chart here. This is going to be the VIX, and the VIX is not showing anything too worrisome just yet. Let me show you a 3-month chart so we can see this in context. There, I've been showing that today. That is the December Fed meeting, and that was a hawkish surprise. And we got a reading that was about 26, 27. We didn't touch that today. So there's still not a lot of fear baked into the market, nothing to write home about, but sentiment is definitely precarious. And I don't know that we're in a situation where that's necessarily bullish for prices just yet.
Finally, crypto.
Yeah, let's get to that crypto because we were taking a look at Bitcoin, and my thesis is Bitcoin is going to 70,000. Doesn't have to happen. We were looking at a couple of different reasons why that could be the case, but I thought I'd take a look at some of the other tokens because Bitcoin, while it has recovered somewhat and it's in the upper 80,000s right now, let's get a current price here, 88,060, and I'll put a 3-month chart on here that goes back to December, and you can see here is that these railroad tracks, that big move up we had yesterday followed by the big move down. Well, let's take a look at Ethereum, for instance, and you're going to see this chart much lower. That move yesterday and today, those are much more in the lower end of that range. So a lot of the other crypto tokens, although we're looking at a lot of green here on the screen, if I show you the 3-day look, not looking that great. If I show you the year to date, the breadth in the crypto market, just not there.
All right, Jared, thank you, buddy.
You bet.
Great as always. B of A Securities, meanwhile, coming out with a new note today on the auto industry. Even though the sector finished 2024 strong, the new year is bringing renewed uncertainty with headwinds from tariffs. And joining me now is the author of that note, John Murphy, Managing Director of B of A at Securities. John, it is good to see you. Want to dive into this note, John, specifically Tesla, because you made some moves there, John. You told your clients you were cutting your target. I believe it was to 380. How come, John? Just walk us through that decision.
Sure, Josh, thanks for having me. There are a number of reasons. I mean, first is we've seen sales really fall pretty significantly in international markets for Tesla, both in Europe and in China, January and February. So there's some extreme pressure there on volumes. The U.S. you're actually doing fairly well. Second, we haven't seen any real significant news or prototypes on the low-cost model that's supposed to launch in the first half of this year. So it's getting a little bit long in the tooth, and we're expecting there might be some real delays there, and I think that'll be a bit of a disappointment. Third, Elon's polarization out there with some of his comments has certainly made some people fearful of the stock, but also of the brand itself. We think that's probably a bit overblown, but certainly out there. Fourth, I think as you look at this, these new model launches are really the kinds of catalysts that you need to get sort of the software side of this going on the robotaxi side, or FSD and robotaxi. So you need to get the hardware out there to really implement the software. And I think that's something that people are concerned about is the hardware's not out there, and actually you might even see some delays on the FSD side. So I think there's those four things. The reality is the Model Y is going through a major changeover. All of its global plants will be down in the first quarter of this year for 3 to 5 weeks. So there might be a conflation of these model delays as well as some of the souring of sentiment towards Elon as pressure on the brand. So we think we got to keep an eye on this. There might be a recovery as we get through first quarter. The first quarter is going to be pretty tough.
John, let me also ask you about tariffs, certainly front and center for investors today. Walk me through possible ramifications, ripple effects for Tesla there.
Well, I mean, Tesla, like everybody's got an integrated supply chain here in North America. So as you see 25% tariffs on products coming from Mexico and Canada, they're going to suffer the same kind of pressure as most other folks. When we look at this, there's about, and this is in aggregate, there's about $100 billion of vehicles and $100 billion of parts coming across the border. So it's about a $50 billion pressure at 25% on profits at the automaker level, which will result to probably in higher prices. For Tesla specifically, I think a lot of the electronic components, particularly wiring harnesses that are coming out of Mexico, where they'll run into similar issues as other automakers and probably need to raise prices. But it's a pressure point for all automakers, and we're likely to see increases in pricing really across the board on average of about $3,300 per vehicle in the U.S. So it's a big pressure point, something that's probably not sustainable for the auto industry, and we'll see volumes come down quite dramatically.
Pricing going up that way, John, in your opinion, is the American consumer in a position to withstand that?
Well, with confidence low, and sort of a lot of volatility we're seeing in the markets and the sort of the consumer sentiment numbers, they're probably not in a position to stomach that. And I think what we're going to be looking at is something that's a COVID supply shock 2.0, right? I mean, the automakers will be producing a lot less of their low-end vehicles and producing a lot more of their high-end vehicles where they can absorb some of these costs and potentially raise price. So no, the consumer is not really in a position to drive that, to absorb that. What we will see is just a richening of mix and potentially lower volume. That'll be not necessarily great for the automakers either, but it's going to be a real pressure point. No, the consumer's not in great shape to handle that.
John, one other point you mentioned, I find it interesting, I want to double click on it, is whether this idea of whether Musk himself is actually impacting fundamentals. And I know he's obviously dove headlong into politics. He's practically living, it seems like, at Mar-a-Lago at this point. And some love him, others not so much. But is there actually any evidence that we have, John, any good data that we can say that Musk is impacting the fundamentals of Tesla here?
Nothing more than anecdotal stories at the moment. So I would say the pressure that we're seeing on volumes here in the near term have a lot more to do with the changeover of the Model Y than any sort of souring of sentiment towards Tesla because of Elon's actions and comments at the moment. I think remains to be seen in the second quarter as the volume comes back up, how much of an impact we'll actually see from potentially a souring of consumer sentiment towards Tesla.
John, always great to see you. Always appreciate your take. Thanks for joining us.
Thanks, Josh.
Stick around. Much more Ask for a Trend still to come. CoreWeave, an AI cloud provider backed by NVIDIA, filed paperwork for an initial public offering on Monday, kicking off what investors hope will be a long-awaited wave of tech IPOs. Joining us now for a look at the IPO landscape is Jay Ritter, University of Florida finance professor. Jay, it is good to see you. So, today, Jay, tariffs, trade war. I mean, certainly, nothing new for investors. We've seen this story before during Trump 1.0, Jay. But I'm curious, listen, it does obviously create uncertainty, volatility, a risk-off day today. What does all that mean, Jay, for the IPO market looking ahead? What are your expectations in 2025?
Well, going into the year, I was expecting a continued increase in the number of IPOs after the very slow activity of the last 3 years. But in the last couple of weeks, the NASDAQ index has sold off 10% from its high. That is not a bullish sign for the IPO market. I don't think it's going to collapse unless the stock market continues to decline. But this decline in public valuations is certainly going to limit how much the IPO market will continue to recover.
Interesting, because Jay, I was recently talking to a venture investor on the show, and it was interesting because after Trump got elected, Jay, in November, after that win, he told me he actually got much more optimistic because Trump won. I asked him why about the IPO market, and he said, well, because I think this is going to be, pro-business, pro-growth administration. Republicans, they take the White House, the Senate, keep the House. That means, we're going to cut taxes, we're going to cut regulation. That's good news for the IPO market. You say what in response to that, Jay?
I think a couple of months ago, that was a very valid outlook. The Biden administration's limits on mergers were bad for venture capital. And for that matter, for a lot of publicly traded companies. But while some of those reduced regulations are still there, offsetting that, more than offsetting that, is tariffs, Ukraine policy, other things that have the market concerned.
What is your line of sight, Jay, into the pipeline of companies that would be interested in going public right now? I mean, are there many waiting in the wings?
There are a fair number, but because of the ample supply of venture capital money, a lot of very prominent companies like Stripe, SpaceX, et cetera, with huge valuations, feel no need to tap the public markets until the time is right. There's certainly opportunities for companies to go public. And with the CoreWeave announcement, with all the excitement about AI, there have been hardly any AI companies going public. And that's one of the reasons why the market is so excited about CoreWeave.
Well, why is that? Why that lack of AI-focused companies going public, Jay? Is it just because, to your point, that a lot of these tech companies have raised just so much money?
Yes, not only that they've raised a lot, but also the ability to continue raising lots of money. CoreWeave is a very successful company. Last year, 1.9 billion of revenue, revenue growing by over 700%. This is the kind of company that venture capitalists and public markets drool over. And the valuation that it's likely to go public at is probably about 18 times last year's sales. So the market is definitely looking at a company like this and saying, yeah, this has great potential. We want more of these.
Is there, Jay, final question, is there a certain kind of private company, a certain profile of a company that you think would be more welcome in a public debut than others in this kind of environment?
Well, value stocks have not sold off as much. So in that regard, there haven't been many buyout-backed IPOs in recent years. And it's possible that even with NASDAQ selling off, there might be some more buyout-backed companies in more traditional industries that go public.
Jay, great to see you. Great to have you on the show. Thanks for joining us.
Always a pleasure.
Stick around. Much more Ask for a Trend still to come. Now for our chart of the day, we're checking in on the S&P 500 200-day moving average. Yahoo Finance's Julie Hyman joining me now with a closer look. Julie.
I've got my Jared Blickery hat on here as we're looking at these technical levels. So moving averages are effectively a momentum indicator for whatever asset, whatever chart that you're looking at. The 200-day moving average, as opposed to the 50 or the 100-day, is obviously a longer-term momentum indicator. And Jonathan Krinsky of BTIG is the technician there, looking at the 200-day for the S&P 500. Here's a candlestick chart of the S&P. So in other words, it shows the daily range here for the S&P. And we got very, very close to that 200-day moving average today, almost kissing it, not quite there. Krinsky's watching this level closely. He says, today feels like the start of more fear in the market here. And he said the S&P, even if it doesn't close at that 200-day moving average, you could argue it's close enough. He said the question isn't whether or not we bounce at this level. We tend to bounce there. He says, what happens then? What happens after the bounce? Is there some sort of follow through? By the way, just to take another longer term look at this, it's been quite a long time in the view of Krinsky, 16 months since we even flirted with this 200-day moving average. So it's been a long time since we've had a momentum breakdown like this for the S&P 500. So he'll be watching closely to see what happens from here as the next indication. Now, I should mention, even though the S&P 500 technically did not break that 200-day moving averages, two other charts did break it today that are important. One of them is the NASDAQ 100, that index of largest cap tech within the NASDAQ. And you see, this one did break it a little more recently, but nonetheless going below that level today. So do we bounce? We did see a little bit of a come up off of that level today after it touched it, did close above that 200-day moving average. But now what happens? And then interestingly, there is one stock in the NASDAQ 100 that also touched its 200-day moving average, and that is Tesla. Here you see the one-year chart here, and closing below that 200-day moving average. That is a level that bears have been watching after this big breakdown that we have seen in those Tesla shares, that more than 40% pullback from the highs. It is now broken below that momentum indicator. We'll see if that one gets a bounce, Josh.
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Have a great night.